In this video, I'll be going through the two problems that you have in Connect for this short Thanksgiving week. While there are only two that you have to complete in Connect, the second one is somewhat challenging. And so I'm going to take a little different approach for the second problem. I'm going to provide the solution, but I recommend that you attempt to complete it yourself and use the solution to check your answers and your method. I will be going through the problem step by step and explaining it to you, and hopefully between providing the solution and describing how to solve the problem in conjunction with what is provided in the text, you'll have a reasonably good understanding of how to solve capitalized interest problems. But before we get to that, let's look at the first Connect problem, which correlates to problem 10-5 in the text. Here we have independent transactions, and they were all made in cash. So this particular problem is not overly challenging. So I did alter some of the data in this problem, and so let's run through these transactions. You've spent, or the company spent, for experimental purposes, research and development of $13,000. Amount paid for failed patent, $7,700. The third transaction, you have a cash price paid for equipment of $23,500 with additional considerations for financing and down payment. Fourth transaction, you have a sprinkler system that was purchased. Fifth, amount paid for successful patent defense. And so let's journalize these transactions. Just to go back to 2 for a minute, this was paid for a failed patent defense. So we have number 2 and number 5. Both are the same kind of transaction, but with different outcomes. They are lawsuits involving patent infringement cases. Well, let's look at number 1 first. We have the amount spent for experimental purposes. This is the research and development, which gets expensed. And the amount I listed was $13,000. And this correlates directly to within the text. So I'm providing the account titles. Connect does that as well. They give you a choice. And the examples are pretty straightforward in the text. There's not a lot to this particular problem. Moving down to the second case, amount paid for a failed patent infringement lawsuit using my value of $7,700. Legal fees expense. In this case, we're going to expense those legal fees because we lost the case. This lawsuit did not add value to the patent. Therefore, we're going to expense those fees because of the outcome. Jumping down to number 5 for a minute. Here we have the same situation, but we won the case. Number 5, amount paid for a successful patent infringement lawsuit of $12,000. Here we are going to capitalize that lawsuit defense into the intangible asset of patent. So that'll add to the value of the patent by $12,000, and then we paid cash. So that covers 1, 2, and 5. Transaction number 3, we had the cash price paid for the equipment. Well, we're going to bring in the equipment at the value of $23,500. That is the value that, and if I just scroll up here, the value of the equipment in number 3 is $23,500 because that is what would have been the cash price paid. So even though we didn't pay $23,500 in cash, that will be how we'll value the equipment. We finance the rest. So we have a notes payable. We financed $18,000, so that's a credit for the liability. And then we paid a down payment of $6,000. So if we're told that the value of the equipment is $23,500 using my altered data, then given the amount financed, the amount of discount has to be $500 and using my numbers. So again, we're given the value. If we would have paid all cash, it would have been $23,500. Because we ended up paying more than that, right? We're going to pay $6,000 plus $18,000. We're going to pay $24,000 for this. Therefore, if the value is only $23,500 and we're paying $24,000, then the discount is $500, which will be eventually expensed as interest expense. And that's why they give us the cash valuation, because that's what we would have paid had we not partially financed this purchase. down to number 4, where we acquired a sprinkler system for $12,000. If it's a building sprinkler system, it could be capitalized into the building. I listed as a separate asset, likely going to have a different depreciation schedule. We'll depreciate that on a different timeline, very likely than we would the building. I think it's probably a little bit more practical to break the sprinkler system out. It's materially significant at $28,000. I would depreciate that on its own schedule. Number 5, amount paid for successful patent infringement. We talked about that one already. And then number 6, commercial exchange of equipment. Here we have fair value of equipment traded, $10,250. Original cost, $7,400. By the way, the $10,250 is altered data. Book value of the old equipment at the time of the trade was $300. Therefore, we have to calculate the depreciation. So the accumulated depreciation at this point will be the difference between the cost and the book value. So we need to know what the $4,400 is. Just take $7,400 minus the $3,000. Once we have that plus the amount of cash paid, then we can journalize the equipment, bringing it in new at $10,250. Close out the old accumulated depreciation account of the asset that we got rid of or traded away. Credit the old equipment to get rid of it, get it off the books. We paid $8,000 in cash, so we credited cash for $8,000. That means that we're going to have, as our plug figure, a loss of $750 on the exchange. So again, nothing earth-shattering in these 6 transactions, but a couple of other problems, especially when you look at number 6. We have an exchange of commercial assets. And this transaction has commercial substance. And just as a reminder, commercial substance means that as a result of the transaction, the cash flows have been changed for the company. On then to problem 10-9, which is your second problem in Connect that you're held responsible for. Again, hopefully you've made an attempt to solve it, and this problem provides a solution with the methods of how to resolve it. So in this case, we're given a project. We're going to build up a building here. In this case, we have to take out a construction loan of $3 million. The objective of this problem is to capitalize interest each year. This is a 2-year project, 21 and 22. And so we have to prorate the expenditures based on how long those expenditures were outstanding during the year. And we only do that to, again, assist us in determining how much interest to be capitalized on the loan. All right, so here we have a construction loan strictly for this purpose. We also have a couple of other existing loans that are not specifically incurred for the purpose of building this building, but to the extent that our gross construction costs exceed the loan amount of $3 million, then we have to assume that we're using the funds available from 2 loans. One loan is at $4 million at 6%, the other loan is $6 million at 8%. So we have 3 loans to consider. Another nuance to this problem that makes it a little bit more complex is that in the second year, we finish this project at the end of September. So when we prorate our expenses, which I'll walk through in a minute, we have to do so based on 9 months of the year because the project ended September 30th. All right, let's take a look at this then. These are the actual expenditures in both years. I've just provided sums of the gross amount of the expenditures. We've got all the data on the loans. One of the things we're going to need to determine is what is the annual interest to be capitalized. And it's based on expenditure since it's less than the amount that we would incur had we just applied it against the loans. So we're going to take the lesser of the outstanding loan balance each year versus the weighted average, time-weighted average expenditures. And we're going to apply the interest rate for each loan against the lesser of those 2 amounts. That is, the lesser of the time-weighted expenditures each year or the loan balances outstanding. And in this case, the time-weighted expenditures were less for both years. So let's prorate the expenditures. Well, you can see the $1 million incurred in January of 2021 was outstanding all year. So it's going to be the full amount, 1 million times 12 twelfths, 12 months out of 12 months. The next expenditure was $600,000, but that expenditure was not made until March 1st. So this $600,000 was not outstanding all year. It was only outstanding for 10 twelfths of the year. So we multiply 600,000 times 10 twelfths. Again, the only reason we're doing this, we're prorating the expenditures, is to assist us in determining how much interest on the loans to capitalize. And that, what we mean by capitalize, of course, is to add into the cost of the building. And we had another expenditure of $800,000. That one didn't come until June 30th, so the year was halfway through. So we'll cut that in half, 6 twelfths times 800,000. And then we did the same for the October 1st expenditure of 600,000. 600,000 times 3 twelfths. So that's the prorated amounts of the expenditures for the first year. Now let's look at the second year, 2022. We had an expenditure in 2022. Expenditure came on the 31st of January. So because it came on the 31st, it was only outstanding 8/9 of the construction year. So how did we arrive at that amount? If the expenditure occurred on January 31st, then it was not outstanding during January. It was outstanding, however, during February, March, April, May, June, July, August, and September. And of course, September in 2022 is when the project ended. So our denominator, when we fractionalize or weight these expenditures, will be 9. So 8/9 of the year is the amount we would apply against the 270, and that gives us 240. The next expenditure was incurred on April 30th. Again, that left 5 months after April 30th till the end of September. So 5/9 times 585. Finally, we incurred our last expenditure on this project on August 31st. That allowed only 1 month outstanding before the project ended. So we have the 900,000 cost times 1/9. As we're weighting these expenditures for purposes of capitalizing interest, remember that even though we're not capitalizing all of the interest incurred during the second year of construction, we still are going to expense the rest. So it's not like we're ignoring all the interest costs. Whatever is not capitalized or rolled up into the building will be expensed on the income statement that year. And we'll demonstrate that shortly. Well, we've got all the prorated expenditures for the first 2 years now. One of the things what I did is added the time-weighted expenditures for 2021. Since this amount falls below the $3 million construction loan, remember this loan was taken out strictly for the purpose of building this office building, then we don't need to consider the other 2 loans in year 1. So we do not need to consider that. Let's look at the amount of interest to be capitalized in 2021. And again, it's going to be based on expenditures because that's less than if it were based on the outstanding loan amount. So in this case, we arrived at $205,000. And we arrived at that by taking the sum of the we'll scroll up here, the 1 million prorated expenditure, plus 500,000, plus 400,000, plus 150. And then plus together, and then we'll just multiply it by the 10%. Since the loan is outstanding all year, purposes of this construction loan, we'll just multiply the prorated expenditures times 10%. So we have $2,050,000 times 10%. So I could have just easily calculated the $2,050,000 times 10% directly. We arrived at $205,000. So that is the answer for the amount of interest to be capitalized, and that's how we arrived at that. It gets a little more complex in year 2 to determine the amount of interest to capitalize. Because in year 2, we looked at our expenditures, and they now exceed the $3 million construction loan amount. What that means is we have a couple more things to do here. We need to, 1, calculate the weighted average rate of our 2 non-construction loans. And our 2 non-construction loans are up here. And how did I calculate the 7.2%? I calculate by just taking the weighted amount times the percentage each year. So for example, in the first loan, we had $4 million on that non-construction loan. And remember, in year 2, we have to use part of this to finish the construction project because the $3 million was not enough. It was enough to cover the first year's expenditures, but not the second. So this weighted average will help us to apply or capitalize the interest on those other loans. So we'll take the 4 million divided by 4 plus 6 million, or 10 million. So we'll take 40% of the 6%, which is the interest on the first loan. And then to that, we're going to add 6 million divided by 10 million times 8%. So 6 million divided by 10 million times 8%. And what we've done is we've weighted both of these percentages based on the loan amount. So because the second loan at 8% is larger than the first loan, 6%, then it will more heavily weight this weighted average amount. $6 million divided by 10 million is 60%. So 60% of 8% will be added in. So what we've done essentially is we've taken 40% of 60% plus 60% of 8%. And we've added them together, and we wind up with a weighted average for the 2 non-construction loans of 7.2%. We didn't have to do this in year 1 again because we had enough loan value on the construction loan to cover year 1 expenditures. But we see at the end of year 2, at the end of the construction project, we've exceeded our $3 million by $870,000. And that includes the amount of previous capitalized interest. So now that we know the approach and how to determine the 271,980, let's walk through it slowly here. What we have done then is we have taken, let me highlight this a little bit. We've taken the $3 million construction loan, because that loan is still outstanding this year, of course, and we're going to multiply that by the interest rate on the loan of 10%, and that's going to get multiplied by 9/12. So 3 million construction loan times annual rate of 10% times 9/12 because the project ended at the end of September in 2022. So that's one portion of the annual interest on the construction loan. So you remember I said that the expenditures in year 2 started to exceed the loan amount? That extra, or $870,000, is now multiplied by the 7.2% times 9/12, that weighted average on the non-construction loans. Again, this is the amount that's financed by the expenditures that exceed $3 million that year. And the expenditures of $3,870,000 exceeds $3 million by $870,000. So $870,000 times 7.2% times 9/12 is the other component of capitalized interest. So we wind up with $271,980 for capitalized interest on the second year loan. I just want to highlight how I arrived at the total accumulated expenditures for 2022. Again, accumulated means we're going to bring in last year's. So what I did is I took the time-weighted expenditures for 2022 of $655. Now this is the time-weighted, and then that's just the addition of $240, $325, and $100. So I'm going to bring those in, plus I'm going to add to that the total accumulated expenditures in 2021. That's everything, the $3 million, because they are now outstanding for more than a year. And then finally, I'm going to bring in the capitalized interest from last year of $205,000. That $205,000 is capitalized as of the end of 2021 and needs to be added in. So this is how I arrived at the accumulated expenditures for 2022. The $3 million total expenditures incurred in 2021 plus the time-weighted expenditures in 2022 plus the capitalized interest from last year. It's that amount that I'm going to apply when I determine my capitalized interest for 2022. All right, so that again, just to reiterate, that's the $3 million times 10% times 9/12 plus the portion financed by the other loans, because this amount exceeds the $3 million loan, times a weighted average of 7.2%, the weighted average on those two non-construction loans, times 9/12. So that is how we arrive then at the, as I said earlier, the capitalized interest for year 2, which is, again, kind of a complex calculation. That is the most challenging part of this particular problem. It's just a matter of applying some of the principles of capitalizing interest. And again, just to reiterate, remember this weighted average only applies to the weighted average of the two non-construction loans. And we only apply that 7.2% against the $870,000, the amount that exceeds the $3 million construction loan. It also asks for the total cost of the building. So the total cost of the building is going to be the gross amount. Remember, the project is now done. We don't have to worry about the time-weighted amounts for construction costs. That issue only applies to determining capitalized interest. When it asks us for the total expenditures, it'll be the $4,755,000, which is the gross amount of all of the expenditures in years 1 and 2, 2021 and 22. And to that, we're going to add in the amount of the capitalized interest in 2021 and in 2022. So it's going to be $4,755,000 plus $205,000 plus $271,980, and that will give us our total of $5,231,980. And then we lastly have to determine what the interest expense is. So again, this is just the interest rates applied against all 3 loans, less what was capitalized each year. So in the first case, how much is to be expensed? We're going to take the construction loan amount times the interest to get the gross amount of interest, plus we're going to take the 6% times $4 million, plus 8% times $6 million, and then we're going to take out or deduct for the first year in 2021, we're going to deduct the amount capitalized at $205,000. Once we apply the annual rates times the amounts in all 3 loans, just deduct the amount that was capitalized in year 1, in 2021. And that'll give you the amount that hit the income statement that year for interest expense, $815,000. We do the exact same thing for year 2. Same procedure, 10% times $3 million, plus 6% times $4 million, plus 8% times $6 million. And then we're going to deduct the $271,980, the amount capitalized in 2022, the second year. And that will be the amount that will hit the income statement for interest expense. They do tell us that these loans are outstanding all year, so we don't need to fractionalize the interest rate. Those loans are outstanding in all of 21 and all of 22. That is the method then for solving problem 10.9. Feel free to replay the videos and check any of the calculations that I went through. If you have any questions on either of these 2 problems, feel free to let me know.